Hi, everyone. We are now going to take a look at Chapter 6, Individual Deductions. Okay, so the learning objectives for our chapter are identifying the common deductions necessary for calculating adjusted gross income. So we're going to be looking at deductions for adjusted gross income. We're going to look at the different types of itemized deductions, which would be deductions from adjusted gross income, as well as the standard deduction amounts for 2021. And then finally, another deduction from adjusted gross income that came out a few years ago, the deduction for qualified business income. So let's get started. Our deductions for adjusted gross income, just bear with me a second. I'm going to grab my book. I don't have it in front of me. Okay. Can be put into three categories. Now, you probably have had an individual income tax class, and so you probably are familiar with these already. Some are directly related to business income. Some are indirectly related to business income. And then we have some are subsidizing specific activities. So we're going to take a look at each group. You can see that we're going to have 15 slides. So those directly related to business activities are those where we're allowed to deduct expenses from our business income. So on our Schedule C, which is for sole proprietorships, any expense allowed, which we'll be covering that more in detail in Chapter 9, I believe, that is a deduction for adjusted gross income, even though it's within our calculations for gross income. For tax purposes, activities are either profit motivated or motivated by personal objective. So business activities then would be our trade or business. Our rental activities would be considered our investment activities. Now in Chapter 14, we talk about rental activities. Okay, but we want to make sure you understand that expenses related to profit motive here, such as our trade or business, these are allowed as a deduction for adjusted gross income as long as they meet the guidelines for deductions. As I said, we will be talking about them in greater detail in Chapter 9. Remember also, investment activities involve investing in property for appreciation or for income payments. So if we're trying to separate the activities, that's what trade or business is focused on. The effort you're putting in as a taxpayer, where investment is you're putting money into a property and waiting for it to appreciate in value or for income payments from it. For instance, real estate, okay, or not even that, but let's say stock, okay? So you pay for the stock, you're waiting for the stock to go up in value before you sell it, or you're waiting for dividend payments, investment activity. Now on page 6-3, we have the typical activity with the type of deduction. So again, when it comes to business activities, we're usually looking at self-employed business expenses. And these will be deducted on the Schedule C. That's what a self-employed individual files their income and allowable business expenses on. And then the profit or loss will be transferred to the 1040. What is not deductible in this category is business expenses related to being an employee. Okay, so we used to be able to deduct them on our tax return. We're not allowed to deduct them at all anymore. Investment activities are your rental and royalty expenses are the typical deduction for adjusted gross income. Now, sometimes, and you'll see this when we get into our itemized deductions, investment interest expense is allowed to be deducted as an itemized deduction. So if you're saying, well, what exactly is that? Sometimes people will take loans to purchase investments. As long as the income from those investments is taxable, or, well, yeah, as long as the interest or the income from the investment is taxable, any interest paid on the loan may be allowed as an itemized deduction. And generally, you can deduct the interest you pay on a loan as an itemized deduction to the extent of investment income recognized on your tax return. And we will be talking about that in more detail as well. What isn't deductible? If you have any special investment expenses related to your stocks or bonds, not rental or royalty expenses, but other types, they're generally not allowed as a deduction. So again, trade or business expenses must be directly related to the business activity. So in your sole proprietor, that's what we're focused on here for now. We'll be talking about partnerships and corporations later, but they're directly related to the activity you're doing. They're ordinary and necessary for that activity, appropriate in helping you to generate a profit, and they're reasonable in amount. They're not extravagant as compared to other businesses who have the same expenses. Now, again, expenses are claimed on the Schedule C of a sole proprietor or a single member limited liability company. They can use a Schedule C as well. Revenues from the same activity are reported on the same Schedule C. Any net income or loss from a Schedule C is first transferred to Schedule 1, line 3 of the 1040, combined with other items, and then transferred to the 1040 itself from the Schedule 1. So it's going to direct you to, let me see if I can get it here now. If you go to page 6-31, you will see on line 8 of the 1040 is where Schedule 1 income ends up. Let me just see one more thing. I could take you back to chapter. Oh, wait, that's itemized deductions. That wasn't it. Bear with me a second. I don't have my pages marked, and I don't think. Oh, yes, they do. If you go to page 6-11, Schedule 1 is there. On line 3 of Schedule 1 is where Schedule C income would appear. They don't have a Schedule C in your chapter. You'll see that in detail in chapter 9, but the profit or loss determined on Schedule C is transferred to line 3 of Schedule 1, and we add up all the other items and then transfer line 9 of Schedule 1 to line 8 of the 1040. So it's just describing the process you go through, but it ends up on the 1040. So those are expenses are considered a deduction for adjusted gross income. The same happens with rental and royalty expenses. As I said, chapter 14 is where we talk about rental activities in more detail, but rental expenses related to your rental activity can be deducted on what we call the Schedule E. So I'm actually just going to take you there quick. Chapter 14. On page 14-22. 14-22, you go to that page, you will see there a Schedule E. And there's actually 3 different properties that could be reported on this. And you can see there that there's rental income, rents received on line 3 of $37,500. And then the various expenses related to property A and the rental activity are listed. And then overall a profit or loss is determined. Well, that is the Schedule E. That amount is transferred to line 5, go back to page 6-11 of the Schedule 1, combined with the other items on Schedule 1, and then transferred to 1040. Okay, so we're just showing you that. Another activity that is allowed deductions for adjusted gross income are those flow-through activities. We're going to be talking about flow-throughs like partnerships and S corporations in this class a little heavier later on in the semester. But flow-through entities are those entities that they're separate entities that file a tax return, such as a partnership and an S corporation. But their profit or loss is not taxed at the company level. Their profits and losses flow through to the owners by their respective ownership percentage and are taxed to the owners. And these are reported on Schedule E on the second page of the Schedule E. And they also flow through to line 5 of the Schedule 1 and then to the 1040. So we'll be talking about them in greater details. We just want to bring them up now. But when the corporation or the partnership that is a flow-through entity is creating the company's tax return, they are being allowed to deduct expenses before the information is even passed through to the owners on their personal tax return. Okay, losses are also considered a deduction for adjusted gross income. Typical type of losses are when we sell a trade or business asset for less than its basis. Okay, they can be deducted on the 1040 as a deduction for adjusted gross income. Losses from investment assets, called capital assets, we talked a little bit about them, are offset against capital gains, and any excess may be deducted up to $3,000 in a year. The amount of capital losses that are not allowed because they're greater than $3,000 in a given year are carried forward indefinitely and allowed as deductions in future tax returns. Excess business loss limitation. So let's get you there. And that's on page 6-6. So taxpayers are generally not allowed to deduct an excess business loss for the year. Rather, business losses are carried forward to subsequent years. Aggregate business deductions over the sum of aggregate business gross income or gain plus $262,000. So let's take a look at an example on the top of page 6-7. Suppose Courtney has been the taxpayer in this chapter that they've run all examples through, invested in a partnership. Now, partnerships are flow-through entities. That this year, her share of business loss from the partnership is $270,000. Assume that $270,000 loss is deductible under the basis. So this means she has that much, she can deduct this. When we see basis, at risk, and passive loss rules, don't worry about that. She is eligible to deduct it. How much of the loss would be deductible on her tax return? $262,000. So we're only allowed to deduct aggregate business losses of $262,000 in a year. Any amount above that, that would be $8,000. She can carry forward to next year and deduct it. So she cannot deduct all $270,000. Now, if she was married, filing a joint return, she would be able to deduct up to $524,000. So that's what we mean when we talked about excess business loss limitation. Okay, so those are usually items that are deducted in us getting to total or gross income. The next few items we're going to talk about are specifically deducted after we determine gross income on our tax return. So I really look at these are deductions for adjusted gross income. And the first one is health insurance for self-employed taxpayers. So Self-employed individuals cannot deduct any health insurance premiums they pay for themselves, their spouse, or their families on the Schedule C itself. Instead, they are allowed to deduct the health insurance premiums they pay for themselves, their taxpayer spouse, and their dependents and children under the age of 27 as a deduction for adjusted gross income to the extent of self-employment income from the specific trade or business. Now, self-employment income would be the profit times 92.35%. So that's the maximum they can deduct of health insurance premiums. Why do they allow this? Well, because generally, health insurance is deductible, but the owners are not allowed to deduct it on their Schedule C. So it's giving them the opportunity to still deduct their insurance. Now, what's really important is, and I'll draw your attention to the bottom of page 6-7, top of 6-8. If the self-employed individual is eligible to participate in a health insurance plan of either an employer they're at or their spouse, they are not eligible to deduct health insurance premiums for self-employment. Quick example, I have a brother who's self-employed and his wife works, and she has a Cadillac health insurance policy, and her health insurance costs a lot for him to be involved with. So let's say it would cost him $5,000 a year, but he is eligible to participate in her health insurance program. Instead, he chooses to take a different, less costly health insurance. Well, he's eligible to take that $5,000 through his spouse's employer. He chooses not to. So because of that, he's not eligible to deduct that self-employment health insurance premiums on his tax return. He could buy this self-employed and have that separate policy, but he can't deduct the premiums. Self-employment tax deduction is another deduction for AGI. So you can see these are both related to being self-employed. So because employers are allowed to deduct Social Security and Medicare they pay on employee salaries, it's only fair that the self-employed individual who has to pay self-employment tax, which is twice the Social Security and twice the Medicare rates on their profits, they get to deduct half of their self-employment taxes as a deduction for adjusted gross income. Just like an employer can deduct their portion of Social Security and Medicare taxes on their employees. So if you look really quick on page 6-8, example 6.6, Courtney reported $18,000 of net income from her self-employed consulting service. Now, remember, a self-employed person must include that profit on their tax return and pay a normal income tax. But then they also have to pay Social Security and Medicare, which is called self-employment tax. But they just don't pay 7.65%. They pay the 15.3%. They pay the employee and the employer portion. So her total self-employment tax is $482. So half of that is allowed as a deduction for adjusted gross income. And if you go to the Schedule 1, back on page 6-11, line 16 is where self-employed health insurance deduction would go. And line 15 is where, line 14 is where this calculation would go. There's also deductions for individual retirement account contributions that you here refer to as IRAs. Now, we're not going to get into how much can you deduct, who can deduct, because there are very specific rules, but do know that certain people, and generally deductibles made to traditional IRAs, not Roth IRAs, but traditional IRAs, up to a certain dollar amount can be deducted as a for adjusted gross income deduction. And you would find that on Schedule 1, line 19. Sometimes if a taxpayer withdraws money early from a certain type of investment, like a certificate of deposit, they will be penalized a certain portion or all of the interest earned because of early withdrawal of the money. Well, what happens is the bank will still report the interest as if it was earned. So the taxpayer will still put the interest income on their tax return, but then they get to deduct the amount that was penalized or they never received because they took the money out early. And that will be reported on line 17 of the Schedule 1. So it's kind of like a wash usually. For certain divorces, alimony payments are deductible. So if you already learned about how we know if something's alimony. If you paid alimony on a separation or divorce agreement that was executed before 2019, but you paid those amounts in 2021, you may be eligible to deduct them as a for adjusted gross income deduction, and that would be done on line 18A. Hold on one second, because I'm not seeing that. This changed. For AGI deduction for charitable contributions. Hold on one second, because I think this changed in 2021. Now, this was in 2020. Yeah, from AGI contribution, charitable contribution deduction. Okay. In 2020, there we go. Yes, in 2020, the IRS allowed us to deduct an additional $300 of cash charitable contributions as a deduction for AGI if we did not itemize our deductions. $600 for married taxpayers filing jointly. In 2021, it's a from AGI deduction, and we'll be looking at that. So you're aware of that. Some other deductions for AGI: student loan interest. So interest on qualified education loans, you can deduct up to $2,500 of interest on education loans. However, this phases out once your AGI exceeds 70,000 or 140,000 for married filing joint. You're not allowed a deduction for student loan interest of any amount once your AGI is above 85,000 for any filing status except filing joint, which would be 170,000. There we go. I want to look at this first. So if your AGI for any filing status but married filing joint is 70,000 or below, you can deduct up to $25 of student loan interest, assuming you paid that much. It phases out, so you deduct less and less, okay, based on a phase out percentage when your income is between 70 and 85,000, or I should say your AGI. Once your AGI is over 85,000, you don't get to deduct any of your student loan interest. And that's how you determine how much you can deduct of your student loan interest. So you take your AGI minus 70,000 and divide it by 15,000. That percentage is not allowed to be deducted, that percentage of the amount. Before we move on though, go to page 6-9. Let's take a look at this. Sorry, I'm losing my voice. We're looking at example 6-8. Assume Courtney's brother, Jason, paid interest on a qualified education loan that he used to pay tuition and fees for his 3 daughters to attend university. In 2021, Jason was married and filed a joint return. He paid $2,000 of interest on the loan, and he reported modified AGI of $152,000. What amount of interest expense is he allowed to deduct? Well, his modified AGI is $152,000. Since it is above $140,000, but not above $170,000, he will take his modified AGI of $152,000 minus $140,000, the lower end of the phase out range, and divided by the phase out range itself. 140 to 170 would be 30,000. So 40% would not be allowed of the amount he paid up to 2,500. So 40% of 2,000 is 800. So of the 2,000 he paid, only 1,200 would be allowed as a student loan deduction. Now that's important. It's not the student who can deduct. It is the person who claims the dependent for the student, okay? So if the student is still being claimed as a dependent on someone's tax return, they cannot take this deduction. Okay, so I think we covered all of the deductions for adjusted gross income. So there's a great summary on page 6-11. And then you can see in part 2 of schedule 1, we add up all of those deductions and we transfer them to line 10A of the 1040. Now you can see on the 2020 1040, charitable contributions, if you take the standard deduction, is another deduction for adjusted gross income. That won't be there in 2021. It will be a deduction from adjusted gross income. So something weird that's going to be changing from one year to the next. So that handles all of those deductions. We've got a brief overview of them. So if you have any questions, please be sure to ask them. The second part of our chapter deals with deductions from adjusted gross income. So we've deducted all of those items we're allowed to get to adjusted gross income. Now, what are we allowed to deduct from adjusted gross income? So the first things we would want to collect together are our itemized deductions, because we can deduct the greater of the standard deduction or itemized deductions. So we're going to look at some specific itemized deductions now. First, our medical expenses. So itemized deductions are generally personal expenses paid by the taxpayer that are allowed as a deduction on our tax return. So you could take a good read through this section, but we are looking at out-of-pocket expenses we pay to treat ourselves, our spouse, and our dependents. They include unreimbursed payments for care, prevention, diagnosis, or cure of injury, disease, or bodily function. Also, if we use our personal vehicle to go for medical transportation purposes, we can deduct up to 16 cents per mile as a medical expense. Also included, hospitals and long-term care facility payments. So you can deduct the cost of actual medical care, whether the care is provided at a hospital or a long-term care facility. It also includes eye, dental, and those types of expenses. Now here's the deal though. You add up all of those eligible expenses and then you subtract 7.5% of the taxpayer's AGI. And that's the amount that will be allowed as a deduction. You can also deduct, this is on page 6-13, lodging while away from home overnight, and transportation to get to medical facilities. It would be for the taxpayer who needs the medical service and one other person, and it's limited. The lodging is limited to $50 per night per individual. Just about every type of medical is allowed here, except for plastic surgery, unless it's to correct an accident or a birth deformity. But the bullet points on page 6-12 really give you a good feel for all of the different expenses. Nothing over the counter is allowed. Prescription drugs, eyeglasses, contacts, lenses, wheelchairs. Over the counter medications, no. Payment to providers such as doctors, dentists, nurses, medical care facilities. Transportation for medical purposes, long-term care facilities, health insurance premiums that you weren't able to deduct anywhere else and are eligible to deduct. And even insurance for long-term care services. Those are allowed as a deduction to a certain extent. So please make sure you go through those examples there and ask any questions you may have. Taxes. Generally, state and local taxes are allowed as a deduction, as an itemized deduction here. And it's the amount you pay in a year, not for when the tax was for, but the year that you actually pay it. State, local, and foreign income taxes, real estate taxes on property held for personal or investment purposes, state and local personal property taxes that are assessed on the value of a specific property. So in Pennsylvania, we don't have this, but in some states, you may pay for a car registration like a flat fee, kind of like Pennsylvania has. But then you also may pay a personal property tax on the value of the vehicle. Well, that is what we're talking about here. Just as long as it's paid to a state or local government and it's on the value of the property. Sales tax can be deducted in lieu of state and local income taxes. So some states only have a sales tax. Some states only have a state income tax. Some states have both, like Pennsylvania. So in states where you have both, you pick one or the other, but you also have the option of selecting. Now, for now, I don't think it's changed yet, if they're even going to change it. The most you can deduct of these taxes for state and local taxes is limited to $10,000. So if your calculation here causes you to go above 10,000, you are not able to deduct all of it. Foreign income taxes aren't included in that 10,000, so you're aware of that. Interest is talked about in greater detail in chapter 14, but basically we talked a little bit about the first item here. Deduction of investment interest expense is limited to the taxpayer's net investment income. So you take a loan, get an investment, any interest paid on that loan can be deducted to the extent of the investment income you actually report on your tax return as an itemized deduction. Any amount that isn't allowed can be carried forward and you can deduct it in future years. Home mortgage interest. You can deduct the interest paid on acquisition indebtedness of up to $1 million if incurred before December 16th. So $1 million of loans. So interest related up to $1 million aggregate loans, 2 homes. So it's not 1 million per home. It's mortgage interest on up to 2 homes where the total loans are 1 million or less. So if the interest is on more than $1 million, you have to allocate it. And that lowers to $750,000 if the property was before or after December 15th, 2017. And that's when the mortgage interest was incurred. Or I'm sorry, when the mortgage was incurred. I'm sorry. Going back sideways there. So they're limiting the amount of mortgage interest, but it is allowed up on as an itemized deduction. Now, acquisition indebtedness is basically saying the original amount of your loan. Okay, so you can deduct up the interest on up to $1 million of your original loan. That's talked about in more detail in chapter 14, because it's a little bit more in depth than that. And you probably are familiar with it already. Charitable contributions of money or property must be made to a qualified domestic charity, and these are also allowed as an itemized deduction to a certain extent. There are special rules for charitable contributions of property, and it's determined by the character of the property. So we separate it between, is it capital gain property? So is it a capital asset, or is it ordinary income property that would be taxed at ordinary rates? And it's like considered ordinary for tax purposes. Now this gets very complex with the system you must go through. First, I'm going to take it page 6-18. Let's make sure we understand what capital gain property is for this purpose. It would be any property. So capital gain property is any property that would result in a long-term capital gain. Long-term capital gain. Ordinary income property. Okay, and so you know that's generally what's deductible on a long-term capital gain. Fair market value of the asset when you contribute it. Ordinary income property, next page, you can deduct the lesser of the property's fair value or adjusted basis. So ordinary property is something that isn't long-term capital gain. Basically, that's it. So you would take the lesser of the fair market value or the original basis. I'm sorry, the adjusted basis. Now, how do we deduct this stuff? And they take you through steps. And there's a great exhibit on page 6-20 that shows you how much, what it is, and how you can deduct stuff. Because not only do we have to put our property contributions into these income categories, but then we have to determine what type of entity or charitable organization was it donated to, because there's further limitations on how much we can deduct. Most charities we donate to are public charities, but sometimes there's private operating foundations. So these are privately sponsored foundations that actually fund and conduct charitable activities. Then there's private non-operating foundations. So these are usually privately funded, but they don't carry on a charitable activity. They donate their donations to other activities, charitable activities, and they cite the Bill and Melinda Gates Foundation. So you're not going to have a huge amount of taxpayers in the private operating and private non-operating foundation categories. But if you have a taxpayer that does contribute to these, there's limitations on how much they can deduct. So for instance, if your taxpayer deducts cash to a private operating or public charity, okay, generally in 2020 and 2021, there were no AGI limits, but generally it's 60% of AGI is the amount that can be deducted. If they deduct cash to a private non-operating foundation, they can deduct or they can contribute as much as they want, but they can only deduct up to 30% of their AGI. For capital gain property donated to public and private operating, fair market value can be deducted, but only up to 30% of AGI. And for non-operating foundations, only basis can be deducted up to 20% of AGI. Remember, ordinary income property, if that's donated to public and private operating foundations like Salvation Army, it's the lesser of your basis or fair market value, but you can only deduct up to 50% of AGI. So if you have any charitable contributions that cannot be deducted because they're above that AGI limitation, you can carry those forward. So let's take a look at these steps. So essentially it's saying, determine the limitation for the 60% contribution if applicable. This isn't applicable in 2020 or 2021 cash contributions. Step 2, apply a limitation to your 50% contribution. So you take your AGI times 50% minus the contribution subject to 60% in step 1. Okay. Then apply a limitation to 30% contributions. And you could read through this. Let's see it in action though. So if you go to page 6-21, we have an example there that really shows this thing in action. This year, Courtney made the following contributions. So she made contribution of cash to the Red Cross, which is considered a 60% limitation because it's a public charity. She made 2 to Goodwill. 1 was for cash. That's a 60% of AGI because it's a public cash. But since she contributed ordinary income property to Goodwill, that's considered a 50% limitation. See the last row of Exhibit 6-9. And then our church, 10,600, which is, and she contributed capital gain property. Now, capital gain property, you can only deduct up to 30% of AGI. So how do we do this? We follow these steps. First step, what is your AGI? 187,000. What were the 60% contributions you made? Now, generally what they say is, okay, what can you deduct? What are all your contributions? 1770. What's 60% of AGI? So it's the lesser of those two amounts that you would be allowed to deduct. But because of this pandemic in 2020 and 2021, they said, don't worry about that. You could deduct it all in those categories. So how much can you deduct of your 60% deduction? $1,770. How much did you make of your 50% contribution limit? 160. What is 50% of AGI? 91,730, which would be 187,000 times 50%. Now subtract that 1,770 that you were allowed for the 60%. So the most you can deduct of this category would be 91,730. She was way below that with 160, so she's allowed to deduct all 160. What was her donation in the 30% category? 10,600. What's 30% of her AGI? 56,100. How much can she still deduct because of her overall limitation? Well, 50% of AGI minus the 1770 minus the 160, she's still allowed to deduct up to $91,570 of contributions. Her contribution is way below that, so 10,600. So she's allowed to deduct all of them. Really quickly, what happens if her AGI was only 30,000? Now let's take a look. Next page. She'd be allowed to deduct all 1770 because there's no limitation. Her 50% contributions are 160. 50% of 30,000 is 15,000 minus the 1770 she's just allowed to deduct. She's allowed to deduct an additional $13,230. So she can deduct the whole 160 in that 50% category. 30% of her contributions in the 30% category were 10,600, but 30% of AGI is 9,000. How much can she still deduct after her 50% contributions? 13,070. So what can she deduct? The lesser of those three amounts are $9,000. So what's the total amount she can deduct this year? 10,930. Now she still has 1,600 of that 30% contribution. She could carry that forward to next year and deduct it next year. So that's how that works. Here's the table I was referring you to. Okay. Another thing, a separate from AGI deduction for charitable contributions for taxpayers who do not itemize their deductions, we can deduct up to, and this is in 2021. 2020, it was a 4 AGI deduction. 2021, anyone who just does a standard deduction can deduct up to $300 of cash contributions, cash, not property, cash, as a from AGI deduction in addition to their standard deduction. There are some other itemized deductions, such as gambling losses. They can be deducted to the extent of gambling income, certain casualty and theft losses on investment property. And if we pass away before we are able to recover all the cost of an annuity, in the year of death, the person can deduct that as an itemized deduction, other itemized deduction. So we look at all of those various personal expenses, the medical, the state and local taxes, the mortgage interest, or should say investment and mortgage interest allowed as a deduction, charitable contributions, and any other deductions, add them all up. Compare them to our standard deduction. Now remember, standard deduction, you have two parts, the basic and the additional. So you get an additional amount for each occurrence. The taxpayer is over 65 or over and or blind. So each occurrence of being 65 or over and each occurrence of being blind. So if you're married filing joint, both are blind and both are over 65, your standard deduction for 2021 would be $25,100 plus $1,350 plus $1,350, both are over 65, plus $1,350 plus $1,350, both are legally blind. So $30,500. Remember, it's the taxpayer and the spouse, not the dependents. Dependents' age and eyesight does not impact the taxpayer's standard deduction. So we calculate our basic and additional standard deduction. And if that amount is above our itemized, that's what we will take as our standard deduction. If it's below, we'll take our itemized. There's a special calculation for individuals who are claimed as a dependent on another's tax return for their standard deduction. Remember, the most people that can file a tax return together are spouses, married filing joint. Children file their own tax returns separate from their parents. So if a child is claimed as a dependent on a parent's tax return or another person's tax return, and they have to file a tax return because they have income, their standard deduction is the greater of $1,100 or $350 plus their earned income. So income from their job or income from being self-employed. But never will their standard deduction be greater than the normal basic, standard deduction for their filing status. Really quick. Let's look on page 6-26. Second example in 623. What if? Suppose that Courtney's 10-year-old son, Duran, earned $600 this summer by mowing lawns for neighbors. If Duran is Courtney's dependent, what is the standard deduction? Well, we take the greater of $1,100 or $600 is earned income plus $350. Since that's only $950, his standard deduction would be $1,100. Go to the next one. What if Duran's earned income is $2,100? Well, take $2,100 plus $350, $2,450 or $1,100. The greater one is $2,450, so that's a standard deduction. What if his earned income was $14,000? $14,000 plus $350 is $14,350. The greater of $1,000 or $14,350, well, that's obvious. However, the basic standard deduction is only $12,550. So all Duran can take is up to the basic standard deduction for a single person. Please let me know if you have questions on that. Okay, so the next few slides talk about bunching itemized deductions and finding the best benefit for the taxpayer. Last thing I want to talk about is the deduction for qualified business income. This is a newer deduction over the last 3 years. And it's there to help out the self-employed, the small business owner. A deduction is limited to qualified trade or business. It excludes specified service, trade, or business. Okay, except for taxpayers with taxable income below. So if your taxable income in a specified service, trade, or business is above these amounts, you are not eligible for it. It's also subject to wage limitation and taxable income limit. That's a great bunch of slides, huh? Go to page 6-29 to see this. Actually, 628. The deduction applies to taxpayers with business income from a partnership, S corporation, or sole proprietorship. So there's the people who are eligible. You can deduct the lesser of 20% of your qualified business income from a qualified trade or business, or 20% of the excess, if any, of taxable income over the taxpayer's net capital gains. Now, how do we calculate that? Let's go right to page 6-29. Courtney performs architectural consulting services outside of her employment, and she also generates rental income from a condo she owns. Will her architectural services and condo rental be considered qualified business income? And the answer is yes. Architectural services are not a specified trade or business, so that's defined on the previous page. Thus, her income from the architectural services would be qualified trade or business income. Income from the condo rental would be considered qualified business income if the activity is deemed to be a trade or business. So that's dependent. Assume Courtney decides to establish a sole proprietorship to perform investing advising services. Courtney reports $250,000 of taxable income before this deduction for qualified business income. Will her income from this advisory services be considered qualified business income? And the answer is no. Advisory services fall within the definition of a specified service, trade, or business. And because her taxable income exceeds that $214,900, the exclusion from the specified service, trade, or business rules based on taxable income does not apply. Thus, her advisory service income would not be considered trade or business income for purposes of this deduction. What if she reports $100,000 of taxable income instead? Well, now since her taxable income is below that upper limit of $164,900, she is eligible to claim the qualified business income deduction on that income. So the key is, what is her taxable income at? If it's above $164,900, she may or may not be able to take the deduction. If it's below $164,900, it doesn't matter what business she's in, she can take the deduction. Assume Courtney decides to establish a sole proprietorship. I'm kind of hurrying along because I'm running out of time. To perform investment advisory services, she reports $194,900 of taxable income. Will her income from advisory services be considered qualified income? If Courtney had $194,900 of taxable income, 60% of her investment advising income would not be considered qualified business income. So there's a phase out range of $50,000 above that $164,900. So only some of it would be eligible for the calculation. So we would take her taxable income of $194,900 minus $164,900 and divide that by 50,000. So 60% would not be eligible, but the other 40% would, and she would be able to calculate her deduction for qualified business income based on that. Okay, and it goes on to talk about other examples in here. It gets really detailed. On page 6-31, though, we ultimately see what happens with Courtney. So again, the two deductions for adjusted gross income, the greater of itemized or standard deduction for 2020, 2021, we will also be able to deduct up to $300 or $600 for charitable contributions if we take the standard deduction. And the other is the deduction for qualified business income. Okay, so those are our deductions for and from adjusted gross income. I invite you to post your questions on the discussion board.